If you've decided that a financial advisor is right for you, it's important to understand some of the differences between the various financial professionals out there, especially because some are more inclined to act in your best interest than others. You most likely already recognize that there are a myriad of financial designations and acronyms out there, and quite frankly, it can be very difficult to understand what means what. And likewise, there are also a ton of people who are willing and able to give you investment advice and guidance. This could be a lawyer or an accountant, a broker, you name it. But it is worth your time to understand that not all advice and guidance you receive from these professionals should be taken at face value. And the reason why you have to be careful with quote unquote professional advice is twofold. First, not everyone is required by law to act in your best interest. And we'll talk about how to determine who is actually looking out for your absolute best interest on the next slide. The second reason why it's important to be careful is because financial professionals are not required to hold any degree in their field. You can contrast this to doctors, architects, or other healthcare specialists who have for years studied their industry in school. So, what this means really for you as an investor is that even if works at a big name firm, it doesn't necessarily mean that that person has any formal background or training. So it's important to seek out those who are really truly masters of their field, and we'll discuss how to pinpoint these people in a couple slides as well. When we look back at our initial observation that not everyone is required to act in your best interest, this is actually a surprising realization for most people because most people assume that financial advisors want you to earn as much money as possible and they want to act in your best interest. But the definition of best interest can sometimes be murky. So when choosing a financial advisor, it's critical for you to ask that person whether she or he complies with the suitability standard or the fiduciary standard. And here's the difference between the two. Those who comply with the suitability standard only need to provide you with advice on investments that are suitable for you, even if the advice isn't necessarily your best option. So, what does this mean? An advisor working under the suitability standard might recommend an investment on which he or she gets commission or a percentage of the money that you are investing. So this is essentially like having a salesperson or a broker as a financial advisor. You hope that this person is doing what is in your long-term best interest, but there's really no absolute guarantee. So overall, what you find with the suitability standard is that it opens the door for the potential of having conflicts of interest because it basically means that the advisor or the broker doesn't have to disclose how he or she is making money. The potential upside here is that brokers are often less expensive than flat fee advisors. When we look at the flip side of the suitability standard, we have the fiduciary standard. And the fiduciary standard requires the advisor to put his or her client's needs and interests above his or her own, and essentially confirms by law that the advisor must act in the best interest of his or her client. So unlike those who work under the suitability standard, for example, fiduciary advisors are usually flat fee based. And what this means is that there are no commissions, there are no incentives for your advisor to try to upsell you a product that might be suitable, but say more expensive than a comparable alternative. And typically, fiduciary, advisors under the fiduciary standard, they're going to charge you a percentage of your assets, either as an annual or quarterly fee. But the issue is that for many millennials, you often must have a minimum asset value of anywhere from 25,000 to upwards of 750,000. And for this reason, fiduciary advisors who work under the fiduciary standard tend to be more expensive than those who work under the suitability standard. When analyzing our second observation, that financial experts are not required to hold degrees in their field, it becomes hard to really understand who the true experts are. And the question arises, or the question of which designation actually means something, tends to arise. So, generally, when looking for a financial advisor, a good rule of thumb is to look for advisors who are either certified financial, or I'm sorry, chartered, that should say chartered financial analysts, or certified financial planners. And the reason why these two designations are important is because the CFP, or the certified financial planner, and the CFA designation, the chartered financial analyst, basically signifies the gold standard of investment advice in the business community. A CFA designation is generally more broad based. It provides a generalist knowledge of areas such as investment management, financial analysis, derivatives, stocks, bonds, etc. And you compare that to the certified financial planner designation, which is almost entirely focused on investing. Those with CFP designations are typically people who are looking to work directly with investors by creating and implementing financial plans and goals. Given that we now know that not all professional financial advisors are created equal, you might be inclined to check and or confirm the qualifications of your personal broker or advisor. If you're working with a broker, you can visit the FINRA website, which stands for the Financial Industry Regulatory Authority. You can visit this website for full public disclosure of your broker and to see or to see if he or she is in compliance with all rules and regulations. And you can also look at the SEC, which is the Securities and Exchange Commission, if you're working with an investment advisor. And this website will offer public disclosure tools to help ensure that your financial professional is qualified and holds the certifications that she or he claims to hold. And if you're working with an investment advisor, you can, like I said, visit the SEC website, or if you aren't sure, you can just check out both. You can also find a fiduciary advisor by visiting the napfa.org website.